Imagine losing your house in foreclosure, but the bank still demands you pay tens of thousands more. That's what happens with most loans. But with one type of loan, your risk stops at your doorstep. Let's break down the truth about non-recourse loans. Ever wondered what makes a non-recourse loan so different from the typical mortgage or car loan? Why do certain investors and homeowners seek them out, even when the interest rates are higher? And most importantly, could this special type of debt protect you when things go sideways? A non-recourse loan is a unique type of loan where, if the borrower defaults, the lender can seize only the collateral, usually real estate or another big asset, but cannot come after the borrower's other assets or sue for the remaining balance if the sale comes up short. In plain English, if you default, the bank takes the house but cannot touch your savings, car, or future wages. So, what's the catch? Why aren't all loans non-recourse? The answer is risk. With a non-recourse loan, the lender takes on much more risk because their only hope of getting paid back is through the value of the collateral. If the property's value crashes, the lender is stuck with the loss. That's why these loans often come with stricter requirements, like lower loan-to-value ratios, meaning you might only get 50% or 60% of the property's value as a loan. Why would a borrower want a non-recourse loan? It's simple. Protection. If the worst happens and you can't pay, your losses are limited to the asset you put up as collateral. Your personal finances, your retirement, and your future income are shielded from the lender's reach. For example, after the 2008 financial crisis, many homeowners in certain states with non-recourse mortgages simply handed the keys to the bank and walked away without the threat of lifelong debt. But here's a key question. Who actually qualifies for these loans? Non-recourse loans are not for everyone. Lenders usually demand higher credit scores, bigger down payments, and proof of strong income or investment potential. They are most common in commercial real estate and some investment property deals, where the property itself is expected to generate enough income to cover the debt. Is it truly impossible for a lender to chase you for more money? In almost every case, yes, but there are exceptions. Sometimes, if a borrower is found to have committed fraud or deliberately damaged the collateral, the non-recourse shield can be pierced. So honesty and good faith are essential. Let's talk about the numbers. Lenders usually charge higher interest rates for non-recourse loans to compensate for the extra risk. Think of it like paying a little more for a safer parachute. You're buying peace of mind, not just money. Still wondering if a non-recourse loan is right for you? Consider your risk tolerance, the type of property, and your long-term financial plans. If you want to protect your personal assets from worst-case scenarios, this loan structure offers a powerful safety net. Because knowing how to limit your financial risk is only half the battle, the next video reveals how to actually secure a DSCR loan, a powerful tool for real estate investors looking to leverage rental income for approval, even when traditional lenders say no. Don't miss the strategies and step-by-step tips that could unlock your next property deal.